What if I told you a company could look profitable on paper, but actually make its shareholders poorer every year? In 1981, Warren Buffett wrote one of his most brutally honest letters. It wasn't just about inflation. It was a wake-up call. If you want to invest better, think clearer, and learn directly from Buffett's playbook, hit that subscribe button now. This series breaks down each of Buffett's letters and pulls out the gold, so you don't have to. Let's rewind to 1981. Inflation is above 10%. Interest rates are at an unbelievable 16%. The US economy is gasping, and businesses are struggling to survive. Inflation acts as a gigantic corporate tapeworm. It preemptively consumes investment dollars regardless of the health of the host. Inflation acts as a gigantic corporate tapeworm. It preemptively consumes investment dollars regardless of the health of the host. Imagine this. A company shows rupees 10 billion in profits. Sounds great, but it needs to reinvest rupees 9.5 billion just to keep up with inflation, rising raw material costs, and depreciating assets. What's left? Almost nothing. That's what Buffett meant when he said, "A business earning 8% or 10% on equity often has no leftovers for expansion, debt reduction, or real dividends. The tapeworm simply cleans the plate." Think of Vodafone idea. It might show revenue growth, but constant reinvestment, debt, and regulatory costs leave no free cash flow. That's not real value creation. Or look at Peloton. It boomed during COVID, but as inflation rose, so did its costs. Despite revenue, it had to burn cash just to stay alive. Buffett categorized companies into two buckets. Category 1, businesses with pricing power and low capital needs. Category 2, businesses that require massive reinvestment just to survive. Such favored businesses must have two characteristics: the ability to raise prices easily and the ability to grow with only minor additional investment. Asian Paints raises prices steadily, low working capital needs. HDFC Asset Management capital light, fee-based model, high ROE. Coca-Cola timeless pricing power, minimal capital to grow. Apple huge free cash flow, high brand premium, low capital intensity. These are the kinds of companies Buffett wanted to own, even if only a small stake, because these are the companies that compound quietly. Buffett didn't just call out bad businesses, he also took a shot at overconfident CEOs who think they can turn them around. Many managerial princesses remain serenely confident in the potency of their kisses, even after their corporate backyards are knee-deep in unresponsive toads. Look at Jet Airways. Multiple management changes, revival plans, even new investors. But it still hasn't returned to operational success. Remember WeWork? Billions spent under the belief it could be transformed. Buffett would have seen that as a classic toad. We've observed many kisses, but very few miracles. Great investors don't try to fix bad businesses. They buy great ones at a fair price, or walk away. Buffett also warned us about something else: accounting. The accounting rules that ignore undistributed earnings diminish the utility of return on equity calculations. Berkshire owned parts of companies like GEICO and Washington Post. These firms kept their earnings instead of paying dividends. Buffett knew those retained profits would eventually show up in Berkshire's value, even if not in the P&L. So, when you look at a stock, don't just ask, "What's the EPS?" Ask, "Where's the cash going? If it's retained, is it growing real value or just feeding the tapeworm?" Here's Buffett's brutal truth. Unless passive rates fall, even companies growing at 14% may be economic failures for their shareholders. Why? Because capital gains are taxed, dividends are taxed, but a 7% tax-free bond gives you predictable cash in your pocket. So if your business doesn't outperform that with real after-tax returns, it's not beating the market, it's losing quietly. Warren Buffett's 1981 letter isn't just about business, it's about perception. In Zen, they say, when the mind is still, the truth appears. Buffett didn't chase noise. He looked through it. He didn't react to inflation or hype. He observed, understood, and chose simplicity. The best investors, like the best monks, know that wisdom comes not from activity, but from clarity. Predicting rain doesn't count, building arcs does. Key takeaways. Inflation kills fake profits. Businesses that can't raise prices or need constant reinvestment are wealth traps. Always look beyond reported earnings. Focus on capital efficiency and true economic value, not growth stories. CEOs can't kiss toads into princes, so don't bet your money hoping they will. Facts do not cease to exist because they are unpleasant. So when markets scream and everyone's running, pause, breathe. Look deeper. What you see between the lines, that's where the real value lives. If this video helped you see through some illusions, hit like, drop a comment, and subscribe for more clarity in a noisy financial world. Tell me, which business in your portfolio is a prince and which one might be a toad? See you in my next video. Happy investing.